Okay, good evening to all of you. Okay, I hope you are all safe and sound. Okay, so welcome to the class. Financial management. Okay. And last time, Monday, we were discussing uh, on how we can estimate the cost of equity. Okay, using two models. Okay, which we discussed one model, which was on the dividend valuation model. Okay, we also did discuss on the capital asset pricing model. Okay, even though we didn't uh, introduce it. Okay, so which we're going to do today. Okay, and maybe just a simple recap of what we did discuss on Monday. Okay, on the use of the dividend valuation model. Okay, when estimating the cost of equity. Okay, so a simple recap of what we discussed last time. Okay, and you see that generally, okay, when it comes to the dividend valuation model, we simply, okay, get that the market value of an equity share, okay, is equal to D naught 1 plus G, okay, or ought to be equal to D naught 1 plus G, cost of equity minus G, okay. Don't get here, we are assuming that you have growth in dividend, okay. So in case it's growth in the dividend, don't forget here, the G is representing, so the G here is representing the growth in the dividend, okay, where G is the annual growth in dividend, okay, so the annual growth in dividend, okay. We entitled to see that, okay, so in case we make the cost of equity, the summation of equation, okay, cost of equity will be equal to D naught 1 plus G. We divide by the current ex-dividend market value plus G, okay. This is what we discussed with the cost of equity, okay. If we assume there's no growth in dividend, okay, if we assume there's no growth in dividend, then the market value of the equity share, P naught, is given us D naught, there's no growth, okay, so without the growth here, sorry. Okay, we divide by the cost of equity, okay, so in case we make the cost of equity, the subject of a formula, the cost of equity will be equal to D naught, we divide by P naught, and of course we express this as a percent, okay, and that given therefore on how we get the cost of equity, okay. Don't forget, P naught is X dividend, okay, that you'll be quite careful, okay, that P naught is the X dividend share price, okay, is the X dividend share price. That's what you have to be careful. So in case you're given come dividend, then you have to work backward until you are able to obtain the X dividend share price, okay. If the P naught is silent, okay, or in case the market price is silent, then of course we assume it is the X dividend share price, okay. And we went ahead and did discuss on how we get the G, okay, the growth in dividend, okay, how we obtain the growth in dividend. And we said that the growth in dividend can be assessed using two methods, okay. You can assess the growth in dividend using two methods, okay. First method you can use is called, okay, first method you can use is called the use of the extrapolation method, okay, the extrapolation method. Okay, simply, we are going to be extrapolating the past into the future. Okay, we extrapolate the past into the future. If, for example, the growth in dividends, okay, in the last number of years has been, for example, 10%, then you can assume that also going forward, okay, the growth in dividend will be 10%. Okay, so we are extrapolating the past into the future. Okay, the past growth in dividend, we assume that will also be the future growth in the dividend. Okay, extrapolation method. Okay. Then you can also use, okay, what referred to as the Gordon's approximation method. Okay, okay, the Gordon's approximation method. Method. Okay, also it's referred to as retention model. Okay, also referred to as the retention model. Okay. Which is what you're going to discuss today on how we get the growth in dividend using the Gordon's approximation method or the retention model. Okay. Okay, so we go back to our notes and we discuss on the model. Okay. On the governance approximation model, or the so-called the retention model, okay, we estimate, or rather we do estimate that the future growth in dividend will be influenced by two main factors. Okay, there are two main factors that do contribute towards future growth in dividend. Okay, one of the first key factor is the return on equity. Okay, so return on equity. So this here, it's return on equity. Okay. So this is return on equity. Now, what's return on equity? It's simply if as a company you're going to be investing, okay, as a company, if you're going to be investing the money, okay, in a project, okay, you have to make an assessment that for every dollar I will be investing in this particular project, okay, for every dollar, for every shilling I will be investing in this particular project, how much profit we are making for each of the dollar, okay. So they call the return on equity, okay, that for every shilling, for every dollar I will be investing in this particular project, okay, how much return does it yield, okay. So here called the return on equity. And don't forget return on equity, okay, just to see a reminder, okay, on the return on equity, the ROE, okay, it's given us the net income, okay, it's given us the net income, we divide by the equity share capital, okay, we divide by equity share capital, okay, of course we express as a percent, okay, that's again the return on equity, okay, that for how much profit, okay, for every dollar of equity that we did invest in this particular project, how much return has it been able to make for the company, okay, the return on equity. Net income we divide by the equity share capital. The other factors that do influence the growth in dividend is the current retention ratio. Okay, how much do we retain? Okay, if in the year 2020, okay, let's say 19, okay, in the year 2019, the company, the amount of earnings we made was $1,000. The next question, out of the $1,000 that we did make in terms of profit, okay, so this is profit, okay, so out of the $1,000 made in terms of profit, how much of that 1,000 did we retain? How much did we not pay the shareholder in form of the dividend? Okay, if the company paid, for example, let's say 200, it means they retained 800. It means in the future, if they have a potential project, it means they can be able to access the 800 and invest in those projects. If the company, for example, paid everything, okay, all the earnings they made to the shareholder in form of the dividend, it implies that they'll be having zero, okay, because they paid everything in form of dividend, okay. If that's what happened, where they paid everything in form of the dividend, therefore the amount they retained is equal to zero. Now, what does that mean? It means in the future, as a company, you may not be able to invest in projects, okay. Why? Because you don't have anything remaining upon which you can use to finance your capital projects, okay. So the more you retain today, there's the chance that in future you may be able to make more investment, and definitely the more dividend you can be able to pay in future because you have more projects you're making, you are investing in future. Okay. Therefore, the higher the retention ratio, the more you retain. Okay, the higher the potential chance the company can be. The company you can be able to make more dividends, you can be able to pay more, to make more earnings, and by default, the more dividends you can be able to pay in future. Okay, what call that's referred to as the Gordon's approximation method. Okay, so there are two variables, okay, that do influence the growth in the dividend. We have the retention ratio, and we have the return on equity. Okay, so those are the two variables that have a key impact on the future potential growth in dividend. Okay. Okay, you can apply the model, okay, and in a question. So let's apply the model into a question. And there goes the question, okay. So go through it, then we discuss together, okay. Okay, I suppose that you have gone through the question. Okay, so here we are meant to apply the model, okay, in getting the growth in the dividend, okay, and at the same time we use the dividend valuation model, okay, to estimate what should be the cost of equity, okay. If I was to get my board. Okay, so for the first thing, of course, we need to get the growth in dividend. We need to get the ex-dividend share price, okay, the value we need to get. And of course, we need to get the most recent paid dividend, okay. So we need to get these variables, okay. So If you have to go to the question, don't forget here we need to apply the Gordon's approximation method, and we say that G is influenced by two factors. We have the retention ratio and we have the return on equity. Okay, so therefore we go to our question, okay, and we get these two variables, okay, the retention ratio and the return on equity. Okay. In this cost question, we do that the return on equity is 12.5%. Okay, so here it is. And you tell that the 20% of the company earnings are paid in form of the dividend. Okay, so if the company pay 20%, it means they retain 80%. Therefore, the retention ratio in this context is 80%, and the return on equity is 12.5%. Okay, we go back to our board. Therefore, retention ratio, the company pay 80, it means they retain 80%. We multiply, therefore, by the return on equity, which in this context is 12.5% to give us 10% to be the annual growth in dividend. Okay, 10% to be the annual growth in the dividend. Okay. Next, we need to get the current ex-dividend market value per share. Okay. And we told that this company is about to pay, okay, 60 cents per share. The price is $2. Okay, so since here the price is not mentioned whether it's cum dividend or it is ex dividend, I think we did conclude and say that as a rule of thumb, okay, that we can assume the price is ex dividend. Okay, so therefore the price here is $200, 200 cents. Okay, in this case is equal to $2. Okay, the P naught. Next is the D naught. However, don't forget D naught is the most recently paid dividend. Okay, the most recently paid dividend. If we go to a question, okay, as I mentioned, don't forget you have to be quite careful with the tense that is being used. So the company is about to pay. Okay, the company is about to pay. It means the company has yet to pay. Okay, the company is yet to pay this dividend. Okay, so that means therefore the 16 cents you have here cannot be D naught. Okay, because D naught is the most recently paid dividend. So this is yet to be paid. Okay, so there's no way our 16 cents can be D naught. So what can it be? It can only be D1. Okay, so it can only be D1, but it cannot be D naught. Be careful with the tense that is being used. Okay, so the company is about to pay. Okay, the company is yet to pay. Okay, so that means therefore that one 16 cents cannot be our D naught. It can only be our D1. Okay. Therefore, we go back to our question here. Remember, the dividend you have here is not D naught. Okay, it's D1. Okay, therefore D1 is equal to 16 cents. Okay, is equal to 16 cents. Okay, I think you have all the variables required in order for us to estimate the cost of equity. Okay, if you can say cost of equity is equal to D1. Okay, now this is not D naught, it's D1 we have. We divide by P naught plus G. Okay, D naught, D1 divided by P naught plus growth, the annual growth in dividend. Okay, which in this case, therefore, will be equal to D1, which you have here, 16 cents. Okay, we divide by P naught. In this case, is $2 plus annual growth in dividend, which is equal to 10 cents. Okay, and I guess we get 18%. I'm not sure. Okay, confirm the answer, and I guess we get 18% to be the cost of equity. Okay. They confirm for me the answer. Okay, either by raising your hand or more or less in the chat. Okay. Yes, and you get 18% to be the cost of equity. Okay, I assume that Esther, you did it right way. Okay, so you get 18% to be the cost of equity. Okay. And that's how we get the cost of equity, okay, after estimating the G by the use of the Gordon's approximation method. Okay. Don't forget what does 18% mean? Okay, 18% means simply imply therefore that as a company, if you're going to ask the shareholder to give you funds, okay, then you must be promising them you'll be paying them 18 cents, okay, for every dollar they shall be giving you. Okay, that's what simply 18% mean. Okay, and that's how you get the cost of equity under the dividend valuation model. Okay, under the dividend valuation model. Okay. At the beginning of the topic, we say that you can use, or we can use two models. Okay, we have the capital asset, we have the use of the dividend valuation model, okay, which you have just concluded on, okay, and then you have the capital asset pricing model. Okay, but before we go to the capital asset pricing model, okay, which you can use to estimate the cost of equity, we need to, let's go through what are the key limitations, okay, of the model. Okay, don't forget, for any model, okay, the assumptions that we are going to be using, okay, or the assumptions that we do use, okay, if those assumptions cannot apply in market realities, okay, then those assumptions become therefore the limitation of the model, okay, the assumption become therefore the model limitations, okay. If you remember all the assumption you mentioned, then you're going to see them here as our model limitation, okay. For example, in a context, don't forget you're assuming that P naught is going to be influenced by, for example, three factors, okay? The dividend, the growth in those dividends, and of course, the cost of equity, okay? However, in reality, those are not the only factors that influence the market value, okay? The market value of an equity share is going to be affected by quite a vast array of factors, okay? Not just the dividend, not just the growth in the dividend, okay? Not just the cost of equity. There are so many other factors that the model ignores. Okay, so that's why that first point is. Okay, it assumes that it assumes a very simplistic assumption. Okay, that the market value of an equity share is purely influenced by those two factors. However, there are many factors that do influence the market value of an equity share. Okay. It assumes a constant growth in dividends. Okay, in reality, they don't have a constant growth in dividend. Okay, when it comes to that, it will be a 10% forever. Okay, so the dividend, the G, is not always going to be a constant. Okay, so the years where the company might pay more dividends because they have made more earnings. There are years where the company will not pay the dividend. Okay, maybe for example, they have more investment they want to make. Okay, and they want to retain as much as possible. Maybe there are years where the company, there are so many factors, okay, that may influence even that growth in the dividend, okay. So assumption that we have a constant, okay, annual growth in dividend, assume that everything in the company will remain as it is today, okay, which is not going to be the case, okay. It might increase, it might decrease in the future, okay. At the same time, don't forget, we assume that the cash flows, the receipt to be received by the holder of that equity investment, okay, they don't get taxed, okay. If the company pay a dividend of $20, then we assume you get the entire $20. That doesn't happen. In some cases, not in most cases, not some, in most cases, individuals or even corporation or investors, they pay tax on the dividend, okay? So you pay, for example, 10% or 15%, okay? Depending on whether the dividend that you're getting paid for, okay, is qualifying or not qualifying. So generally, okay, there are things that do influence. You need to consider, okay, the tax, okay, because the net receipt to be received is not equal to gross cash flow, okay. Then growth in earnings assumed, okay, and if you take into account the capital gains to be earned, okay, even though we did defend this point, okay, it's still an assumption that which we did defend, okay, that in case we have to assume that this particular company does not close down, okay, the company does not go into bankruptcy, then it makes no sense to include the capital gains, okay, why? Because the underlying or the fundamentals of that equity share remain as they were, okay, irrespective whether the equity share changes from one investor to the investor, the share remains as it was, okay. So, and of course, it also ignores the cost of rotation, okay. We are saying that, okay, for example, the example you have just concluded, the cost of equity is 18%, okay. But if the company, for example, was to go to the market, okay, and they want to get equity finances, okay, then they must be promising the shareholder a return equal to 18%, okay. However, don't forget, over and above that, the company also do incur some costs, okay? They do incur some costs when it comes to, for example, the issue of the shares, okay? Which this model ignores, okay? Which this model ignores, okay? So all the costs that I incurred, all the issue costs, okay? The amount you pay to the auditors, the amount you pay to the lawyers to assist you in preparing the prospectus, the amount you pay to, for example, the CMA to have your share listed, to have your shares authorized. Okay, so there's so many costs you incur along the way. Okay, however, all these we do ignore. We only consider from the shareholders' perspective. Okay, we only consider from the shareholders' perspective, the 18%. Okay. Okay, those are some of the assumptions of the model, okay, of course, which we did say become therefore the limitation, okay, of the model, okay. And that marks the end of the dividend evaluation model, okay. Any question, don't forget to raise your hand, okay, you can have it on the chat. Okay. The next model, okay, which you can use to estimate the cost of equity, okay, is called the capital asset pricing model, okay, the capital asset pricing model, okay. And this model comes in, okay, because of the limitation, okay, that you have just mentioned, okay, that applies on the dividend evaluation model, okay. We need to make an assessment, okay, we need to see, is it possible for us to use a model with the limitation a bit lower, okay, that is a bit more realistic, okay, it's a bit much closer to the market realities, okay. And the capital asset pricing model says that if as a holder, okay, you're going to be investing in a risky company. If you are an investor, you are an equity shareholder, okay, if you're going to be investing in a risky company, then definitely you would be expecting more returns, okay, that you could be expecting the company to reward you, okay, because you are exposing yourself to a next risk, okay, you are exposing yourself to next risk, okay. So the capital asset pricing model comes in and trying to quantify, okay, the amount of risk that you will be exposed to, okay. How much risk will I be exposing my money, my funds, my capital in case I choose investment here, okay. So here is about the quantification of the risk. Okay, so the model comes and says that the key driver, okay, towards the cost of equity, the key driver towards the return the providers of capital expect to receive is based on the amount of risk they are exposed to. The more the risk exposure, the more return they will be demanding. Okay, which exactly is a reality. Okay. You don't choose an investment if the investment exposes you to high risk. Of course, you would expect it to have a high return. Okay? Because why would you want to invest in a high risk project? It gives you low return. Okay, so that's on the capital asset pricing model. Okay, it comes in to try to check on the limitations we have mentioned. Okay, on the dividend valuation model. Okay. So CAPM, or the capital asset pricing model, it is a method of determining the cost of equity that incorporates risk. Okay, if you remember, we say that the return the provider of capital shall be received is given as risk-free plus risk premium. Okay, the risk-free rate of return plus risk premium. Okay, so here we're trying to quantify the risk premiums now. Okay, so just to recap, okay, don't forget the risk return to the investor is given a risk-free plus a risk premium. Okay, we mentioned this at the beginning of the topic. Okay, so here we are trying to quantify how much premium the equity shareholder are going to be requiring. Okay, for them to invest in this particular project. Okay, based on the amount of risk we shall expose them to. Okay. Generally, okay, investment or rather investment in equity in financial assets. Okay, there are two main types of risks that we ought to consider. Okay, there are two main types of risks we ought to consider. Okay, so let me go back to my board. Okay, to have a simple discussion on the risks. Okay, so there are two risks that we ought to consider. So the amount of risk that again we expose investors to, okay, we have first classification is called the systematic risk, okay, referred to as the systematic risk, and then we have what we call the unsystematic risk, okay, the unsystematic risk. Those are two types of risk exposure or the risk that the investor could be exposed to, okay, the systematic risk, and you have the unsystematic risk, okay. Now, what's the key difference? Okay, the systematic risk more or less is going to be a risk that more or less all the investor within the particular market, okay, all the investor within a particular market shall be exposed to. Okay, the degree of the exposure might be different. However, every single investor in that particular market shall be exposed to that risk. Okay, called the systematic risk. Okay, so every investor in that particular market, they will have to, in one way or another, okay, have to bear that risk. Okay, And as I mentioned, okay, the extent or to which they shall be bearing this risk is going to be a bit different. Okay, some more exposure, some others less exposure, but there will be exposure. Okay, that's the key term or the key term there. Okay, then you have called the unsystematic risk. Okay, or the non-systematic risk. Okay, this risk essentially, okay, it will be affecting, okay, it will be having an impact on investors, okay, for a particular firm, okay, for a specific firm, okay. Not all investors in that particular market shall be exposed to that risk, okay. So it's only some few individual investors in a given company that shall be experiencing that exposure, that risk exposure. Okay, not everyone in the market. Okay, it's only going to be what we can refer to as a firm-specific risk. Okay, firm-given risk. Okay, the exposure only applies to investor in that particular firm. Okay, in that particular firm. Okay, that's referred to as the unsystematic risk. Okay, we have the systematic risk and you have the unsystematic risk. Okay, so this is what we need to consider in the model. Okay, the two risks. Okay, both the systematic risk and unsystematic risk. Okay, let's go back to our notes. We discussed the two risks in detail. We mentioned that the systematic risk, okay, also sometimes referred to as the non-diversifiable risk. The key reason why we are referring to it as the non-diversifiable risk is that irrespective of which investment you choose, if you choose A, you choose B, you choose C, in that particular market, don't forget the exposure, you will be exposed to it. Okay, so it does not matter which stock you take, it does not matter which security you will be investing your money in, the exposure will be there. Okay, the degree of the exposure shall be different. Okay, some far more exposure, other less exposure. However, okay, you will be exposed to it. Okay, and that's why it is non-diversifiable. You cannot diversify. You cannot do away with it. Okay, well, that's why you're calling it as the non-diversifiable risk. Okay, and this affects all the firms in an economic region and cannot be reduced or diversified away by increasing the number of securities in the portfolio. Okay, so as individual investor, you cannot be able to do away with that particular risk. Okay, so every single investor in that particular market shall be exposed to this risk. Okay, a key term here that comes up is what we call a portfolio. Okay, a key term that has come up here is what we refer to as a portfolio. Now, what is a portfolio? Okay, let me go back to my board. Okay, to discuss what do we mean by portfolio. Okay, so it is not possible to diversify this risk. Okay, that's why sometimes this risk is also called the non-diversifiable risk. Okay, the non-diversifiable risk. Okay, actually, sometimes it cannot be referred to as market risk. Okay, because it affects the entire market. Okay, it affects the entire market. Okay, or market risk. Okay, now, one of the way that you can be able to diversify the risk, okay, by this risk here, is by having more asset in a portfolio. So portfolio, okay, so a portfolio is simply an investment that you make. Okay, this is going to be an investment, okay, that we make in investments that as a company or as an investor, you do make, of course, in more than one assets or in more than one class of assets. Okay, for example, you can have investment make in equity. Okay, you also have investment that you make in bonds, in preference share, in real estate, for example. Okay, if you're going to view this group of this basket as a single investment, okay, equity shares, bonds, real estate, if you view them as a single investment, okay, if we view them as a single investment, then this is what referred to as a portfolio. Okay, this is what referred to as a portfolio. Okay, we are going to view all these investment in equity share, in bonds, in real estate, okay, in farmland, for example. Okay, so all these become therefore what we call a portfolio. Okay. Now, one of the ways that can be able to diversify or reduce, okay, the risk, okay, is by increasing or by having more security, okay, by having more assets, okay, by having more assets in this portfolio. Okay, in this case, for example, if we have one equity share, we have one bond investment, we have one real estate investment, okay, it means our portfolio is made of 3 assets, okay, or a 3-asset portfolio. Okay, so in this context, for example, here, this is what we call as a 3-asset portfolio. Okay, So you can diversify, for example, okay, your risk exposure by increasing by increasing the number of assets from 3 assets, for example, to generally, okay, if you're going to have at least 16 assets, okay, if you're going to have, for example, at least 16 assets in your portfolio, then you have been able to do away with this risk, the one you mentioned here, okay. You can be able to now do away with the unsystematic risk, okay. If you can have, for example, at least 16 assets, okay. So generally from 16 to 30, you have been able to do away with all the unsystematic risk, okay. You have been able to do away with them, okay. Okay, and that's what we refer to as a portfolio, okay. It's going to be an investment, okay, that is made of different individual assets, okay, different individual assets. If possible, okay, they should be in different asset category, okay. Equity, bonds, okay, not just equity, okay. You can also have a portfolio that is made of equity investment only, okay. That can happen, okay. You can have KCB equity shares in the investment. You can have Snapchat investment, equity share investment. Okay, so it is possible, okay, to have a portfolio made of assets in a single class. Okay, only equity share, only bonds, only the estate. So it is possible. Okay, however, it makes all the diversification is going to make more sense in case you're going to have more than one asset class. Okay, not just equity, not just bond. Okay, not just real estate. Okay, having more asset class will make more diversification. Okay, to reduce the risk. Okay. So you can be able to do away with the risk, okay, the unsystematic risk, okay, by increasing the number of securities, okay, for example, from 3 all the way to at least 16, okay, to some extent, all the way to 30 assets in the portfolio, okay. That's what we mean by portfolio. Okay, I will come back to the portfolio in a bit. Okay. So let's go back to our notes. And as mentioned, the systematic risk is going to affect all the investors, all the companies in the same way. Okay, as I mentioned, although to some varying degree, some other companies more exposure, other company a little exposure. Okay, it includes number of factors. Okay, so number of the factors that do contribute towards the this risk. Okay, there are a number of them. Okay, you have, for example, political instability. Okay, we have high inflation rate in the economy. We have maybe high unstable currency. Okay, also an unstable currency can be one of a contributor. Okay, in case you have a very unstable currency. Okay, in that particular market. Okay, for example, the case of Zimbabwe. Okay, that's a very unstable currency. Okay, I actually don't think they have a currency. Okay, they do use US dollar. Okay, so also in case the country has a stable currency in itself can also be a hit on the business. Okay, don't forget everyone is being affected. Okay, in case that particular country has a stable currency. Okay, also in case we have high okay, so actually unstable currency and forex come okay to are the same thing. Okay, so okay, I can just here high. Okay, forex risk. Okay, foreign exchange risk. Okay, foreign exchange risk. Okay, so can be one and the same thing. Okay, high foreign current exchange risk. Okay. Also, you have, if for example, we have high interest rate that country charges. In case we have high interest rate, can be another factor. Okay, the high interest rate. And of course, an example here, in case you have maybe even an epidemic, okay, but the one you're experiencing, it's your don't forget, every person is affected, okay. There's no one can say that he has been shielded, okay, away from that risk, okay. So everyone is being affected, okay. Even case of oil prices, okay, in case we have unstable oil prices or crisis, okay. So all these will be factors that do influence the investors in that particular market. Okay. In case we have even a legal system, okay, a legal system that is going to be maybe unjust legal system, okay, unjust legal system, okay, so it will be affecting every investor in that particular country. Okay, so all these are factors, okay, that may influence the investment that investors are making in that particular country. Okay. Don't forget, you can't do away with them, okay? You have to bear them, okay? The degree to which you bear them might be different from one investor to the other investor. However, you will be exposed to this risk. Okay, there will be a risk exposure. Okay, let's call the systematic risk. Okay, the systematic risk. Okay. Then you have to call now the other classification or the other group of the risk, okay, which are classified, referred to as the unsystematic risk or the non-systematic risk. Okay, in that category, therefore, now these are risks that generally, as I mentioned, okay, they are going to be affecting only individual firm. Okay, they are firm specific risk. Okay, they are firm given risk. Okay, so it's not every firm within that particular market that shall be exposed to that risk. Okay, in case you're a firm where there is high corruption, okay, in that particular firm, okay, it does not mean that the firm next door there is corruption. Okay, if we have a firm that has poor management, okay, they have management who don't have enough experience, okay, it does not mean that the firm next door have management that are inexperienced, okay. If this firm, for example, cannot be able to raise funds in the market because it is perceived to be a risky firm, it does not mean the next firm might not be able to raise fund, might not be able to obtain money, okay, bank loans, okay. It may be because you as a firm, okay, you have poor credit rating, okay, and that's why you cannot go to access the funds. You can't go to access the capital market. Okay. Now this is going to be factors that only influence that particular firm. They're only going to be influencing that particular firm. Okay, that call the firm given risk. Okay, they can be diversified. Okay, if for example this firm A that you have your current investment in, okay, has for example fraud. Okay, it has for example fraud. Okay, you can decide I'll diversify. Okay, I'll invest elsewhere. Okay, to another firm where there's little fraud. Okay, or I can decide. Okay, this particular firm that I'm investing, okay, there's too high risk that if, for example, the owner of the business or the founder of the business, okay, if he dies, then he died with the idea, okay. So what do? You can jump ship before that happens, okay. So it is possible for you to diversify that risk, okay, and that's why you're calling it is a diversifiable risk, okay. You can be able to do away with the risk, okay. And how do you diversify? One of the key examples, simply by increasing the number of assets you're going to be having in your portfolio. If you currently your portfolio is made of 3 assets, you can decide, let me increase from 3 to at least 16. Okay? So you can diversify. You can go to do away with that risk by simply how you do construct your portfolio, how you make your investment. Okay? And that's on the unsystematic risk. Okay, that's on the unsystematic risk. Okay, so since they are diversifiable, okay, therefore I will go back to my board. Okay, so since they're diversifiable, okay, then it is possible for us to do away with them. Okay, so it is possible for us to do away with them. So they're also called, therefore, they can also be referred to as diversifiable risk. Okay, they also refer to as the diversifiable risk. Okay, also I'm trying to refer to as since as an individual investor, you can be able to do away with that risk. Okay, since as an individual investor, you can be able to diversify the unsystematic risk that the market is not going to be giving you any return if you expose your investment to the risk. Okay, because we are assuming that you are a rational investor. Okay, so in case your investment, your portfolio, okay, has the unsystematic risk exposure, then the market is not going to give you any premium. Okay, because you're going to be deemed to be in quote a lazy investor. Okay, therefore in that case, in that context, therefore they also refer to as the unpriced risk. Okay, there is no premium. Okay, so there's no premium to be received. There's no price. Okay, that you do get in case you're going to be exposing yourself to that risk. In the case of the systematic risk, okay, yeah, we have said that you cannot diversify them. Okay, since you cannot diversify them, the market itself, okay, ought to be giving you premiums, okay, because it is not because you are lazy in quote, okay, that you assume that risk, okay, it's because of the market you have invested in. Okay, the market itself is one that is going to be causing you to exposing your investment to. Okay, if the markets need to give you premium in case you if the market is exposing you to that risk, okay, and that's why sometimes they also do what call as a price risk. Okay, they also refer to as a price risk. Okay, so those are the two main type of risk exposure that you can have in case of In the case of investment, equity investment, you may be exposed to systematic risk and you have unsystematic risk. Okay, systematic and you have the unsystematic risk. And you see that generally that it is possible, okay, for you to reduce the unsystematic risk by increasing the number of securities you have. Okay, that it is possible to diversify. It is possible to reduce the risk. Okay, by increasing the number of assets we have in our portfolio. Okay, in case as to make a simple graph here, if we are to make an assumption, okay, this is our graph here. Okay, this is risk. Okay, you can measure the risk as we can measure the risk using standard deviation. Okay, and here is the number of. Okay, let me just do the reverse. Here is the number of securities. This is the number of securities, or the number of assets in a portfolio, and here is the risk. Okay, so as measured by standard deviation. Okay, as measured by standard deviation. Okay. Now we are saying that in case you do increase the number of securities, if for example we start off with our portfolio made of 3 assets, okay, now it is going to have a higher risk than in case we have a portfolio made of, for example, 16 securities, okay, and or in case it's made of 30 securities, 30 assets in the portfolio, okay. Now, as we increase the number of securities, as we increase the number of assets in a portfolio, we have said that there's some risk that you can be able to diversify, okay, the so-called diversifiable risk. Okay? So in case we do increase the number of securities, then you're going to have that happening, okay? That you're going to have some risk being reducing, okay, being diversified, okay, depending on the risk that we are in, the risk that we are experiencing, the risk that is affecting our portfolio. However, we have mentioned, okay, that there's some risk that you can diversify, okay, the one you just mentioned, the so-called the systematic risk, okay, they are not pegged on the number of securities. It does not matter, okay, and that's what you can see, therefore, our curve here sort of is, okay, like our curve here is sort of like, okay, coming to a plateau here, okay, sort of, okay. So here, this part of risk which you cannot reduce, okay? So this component here, which you cannot be able to, this component here, okay, which cannot be able to do away with, okay, by increasing security, by increasing the number of assets in a portfolio, is what we refer to as the systematic risk, okay? It's what we refer to as the systematic risk, okay? The systematic risk. However, the top component, okay, which we have here, okay, the top component which you have here, okay, so this top component, which we are able to reduce, okay, by simply increasing the number of securities in the portfolio, and so what we refer to as the diversifiable risk. In this context, the unsystematic risk, okay, the unsystematic risk, okay, and the key difference between those two risks, okay, the key difference between those two risks, okay. Okay, there's a time the examiner was asking you to draw this graph, okay, to make a distinction between the systematic risk and the unsystematic risk, okay. There's a time that your examiner did ask this question. So in case you can draw to your question bank, okay. Okay. So in case you go to your question bank, is somewhere one of the past paper question where the examiner was asking you to actually draw this graph, okay. So look for it. In case you get it before me, don't forget you let me know. Okay, so I seem to be have a question here on the November 2019 question 3A. Yes, here it is. Thank you, Luke and Diar. So in the November 2019, okay, question 3A, okay, if you go through it, it's asking you, using a well-labeled diagram, distinguish between systematic risk and the unsystematic risk, okay? I think you have just made that distinction, okay? So here you're simply meant to draw this graph, okay? To make that distinction between the systematic risk and the unsystematic risk, okay? So more or less this is what you are meant to have done in that question, okay? How do we diversify the systematic risk and how do we diversify our unsystematic risk? Okay, that's a graph you're meant to have done in that particular question. Okay. Okay, if you go back to our notes. Now we see that so far we are making one common assumption, okay, when it comes to the application of this model, okay, and one of the key assumption that we are making is that the investors are assumed to be rational, okay, the investors here we are assuming them to be rational, okay. Now what is rationality? Okay, rationality we are simply trying to say that, okay, is that the investors are going to be wealth driven. Okay, the first key thing. Okay, the investors we have are going to be wealth driven. Okay, so then they have to consider. Okay, if I chose investment A, how much return will I be making? Okay, at the same time, they also have to consider the amount of risk that we shall be exposing ourselves to. Okay, if you choose this investment, how much risk do I expose myself to? Okay, so it's about simply risk and return. Okay, risk and return. Okay, the more risk I will be exposing myself to, the more will I will be demanding. Okay, the more return I will be demanding as an investor for my investment. Okay, the assumption we are making, okay, is that the investor do hold what we call a diversified portfolio. Okay, diversified portfolio. Okay, this particular portfolio has at least in a complex here. For example, it has at least 16 equity shares. Okay, or 16 assets. Okay, therefore the part for the diversifiable risk, the part for the unsystematic risk component has been done away with. Okay, so we don't expose ourselves. Okay, or this portfolio you have has zero unsystematic risk. Okay, that's another assumption we are making in this particular theory. Okay, that the investors do hold a well diversified portfolio. The only risk their portfolio is exposed to is only the systematic risk, is only the market risk. Okay. Then you have another assumption that you're going to be using here, what we call linearity, okay, trying to assess the return and the risk, okay. I think I already mentioned that. But generally, okay, if you're to make a comparison of the risk, okay, of the market, the entire market, okay, the entire market, how much risk exposure does it have, okay? If you're going to have an instance where our risk is higher than all the market, okay, the risk of this particular security is higher than the risk of this particular asset, okay, then the return for the asset must be greater than return to the market. Okay, so the market, since the risk to the individual asset is high, okay, then therefore the return to be given must be high. Okay, and this is called this is an element of linearity. Okay, it's an assumption we're making. Okay, the more the risk, of course, the more the return. And here is only the systematic risk here we mean, okay? No the unsystematic, only the systematic risk that we are assuming, okay? There's an assumption we're making. Those are the two core assumptions, okay? The other assumption, but these are two core assumptions, okay? The investor first assumption is the investor do hold a well diversified portfolio, okay? The other one, the element of linearity, okay, and maybe the other major assumption is on the rationality, okay, that the investor assumed to be rational investors, okay, so it have it to be the element of rationality, okay. And these are with maximizers, okay, and they're going to be driven by purely the return and the risk, okay, they're going to be purely be driven, okay, when it comes to making investment choices. Their main driver is return and the risk. Okay, the element of rationality. The assumptions, okay, the more the normal uses, okay, over and above those two assumptions, three assumptions you made here, is that if you remember, we did discuss at the beginning of the topic, okay, is that when it comes to the amount of risk that we are exposing the investor to, or the investor you are exposed to, okay. Of course, the first thing is that you must be receiving, on the bare minimum, okay, the amount of return you should be receiving is a risk-free rate of return, okay. On the bare minimum, the amount you should be receiving is the risk-free rate of return, okay. However, since we are investing in a risky asset, then the return to be received must be in excess of that, the risk-free rate of return. Why? Because you are investing in a risky asset. Okay, since you are investing in a risky asset, okay. So the other is that, okay, which I think you have mentioned, is that the investor hold a well-diversified portfolio, okay? So therefore, the portfolio the investor is holding has zero systematic risk, has zero unsystematic risk, okay? Don't forget, for the systematic risk, you don't reduce by having a well-diversified portfolio, okay? The assumption number 3, okay, is that capital markets are perfect and efficient such that there is no cost of transaction, okay. If you want, for example, to diversify your portfolio, then there's no cost associated by your diversification, okay. Okay, then this rationality, I feel it's here, okay, the element of rationality, okay, the investors are rational and they risk averse, okay, so they don't jump on investment because it seems to yield high returns, okay, they are also have to consider, of course, the risk, okay, how much risk will I be expose myself if I get an extra return, okay, so that is going to be a factor that they shall be considering, okay, and those are the assumptions that do apply in the capital asset pricing model, okay. The first two assumption, okay, rationality being one of the key or the key assumption, okay, diversification, okay, that the investors do hold a well-diversified portfolio, and also we have the element of linearity, okay, that there's going to be a linear relation between the risk and the return, or simply between the market return and the return of the individual securities. Okay, those are the assumptions we have for the capital asset pricing model. Okay. In case you have a question, forget you let me know. Okay. Now, essentially, don't forget you have mentioned, okay, that the market is going to be only be rewarding. Okay, the only priced component of the risk is the systematic risk. Okay, so in case you have a risk exposure, okay, where we don't, okay, in case you have exposed yourself to, in case you have exposed yourself to any of the unsystematic risk, then there's no return you'll be receiving. Okay. Now, we need to therefore be able to measure the systematic risk, okay, because that is what the market is going to be rewarding. Okay, therefore, as an investor, you have to quantify how much of the risk will I expose myself to. Okay, so if I go back to my board here, okay. So we need to assess, okay, now how do we measure the asset systematic risk or the equity share systematic risk? Okay, one of the common tool, one of the common model as say measure we use is called the use of the beta coefficient. Okay, the use of the beta coefficient. Okay, the use of the beta coefficient. Okay, and the beta coefficient essentially is what we refer to as it is a measure in itself. Is a measure just like standard deviation, okay, which we're going to use to measure the amount of risk, the total risk exposure. Okay, now the beta coefficient, okay, is used to assess only the amount of systematic risk that we do expose the investor to. Okay, so here is used to measure. Okay, so it is a measure. Okay, in itself is a measure of asset systematic risk. Okay, of asset systematic risk. Okay, the beta coefficient. Though we're only measuring the asset systematic risk. Okay. In the case of if you want to assess the total risk, then we use, for example, the standard deviation. Okay, so here the only concentration is on the systematic risk. Why? Because there is no premium, there is no price that you shall be receiving in case you expose yourself to the unsystematic risk. Okay, that's why for now we don't consider that, because don't forget the assumption for the model is that the investor hold a well-diversified portfolio. Therefore, no return you'll be receiving if you expose yourself to any unsystematic risk. Okay. And the beta, don't forget you're trying to compare, okay, the risk that you expose yourself as an investor versus the market. Okay, don't forget we say that this is can also be referred to as a measure of market risk. Okay. Now, how much risk do we expose ourselves compared to the entire market? Okay. Therefore, summing the beta coefficient, okay, the beta coefficient, okay, of let me security I, okay, let me call it security I, is given us. We want to compare, okay, we want to compare this particular security versus the entire market, okay. We are comparing the market, we are comparing this security and the market versus the entire market, okay. It was given us the covariance, okay, between this security, okay, and the market, okay. So I here is the security. It can be A, it can be B, it can be C, okay. Now M represents the market, okay. So it's a covariance, okay, of that particular security versus the market. We divide by the variance of the market portfolio, okay. So the variance, okay. So here, just to these tables I've used here, okay. This is not very good. Let me do it again. Okay, so this is the beta coefficient. This is the beta, okay, coefficient of I towards the market of I, of asset I, of asset I, okay? Let's call this of the beta coefficient, okay? Then this table here is the covariance of asset I, I don't forget, this is just a symbol I'm used. I can be A, can be B, whatever you want to call it, okay? For my context here, I'm calling it I towards the market portfolio, towards the market, okay? M is the market here, okay? So don't forget, covariance is simply how do the return of this particular stock, okay, move with the market, okay? They call the covariance, okay? How do the return of this particular stock move with the market? For the covariance, okay? I think we shall discuss later on in detail, okay? Now this is the theta, okay? Simply the symbol for the standard deviation of the covariance, okay? So the covariance, okay, of market portfolio. No, this is the variance, sorry, okay, not covariance, okay? The variance of market portfolio, not covariance, the variance of market portfolio, okay? And that's how you do measure the beta coefficient of asset I, okay? So there's a covariance, okay, of the particular security towards the market. We divide by the variance of the entire market, okay? That's how you do measure the beta coefficient as a measure of systematic risk exposure of that particular security, okay? Now, if you also have a question here, okay, in case we are dealing, okay, with an asset, in case we are dealing with an asset, okay, where, or rather, I want to ask a question, okay, if you want to assess, okay, the beta coefficient of the market portfolio, the market portfolio is the systematic risk for the entire market, okay, is not to a particular asset, it's for the entire market. Now, if I want to assess the beta coefficient of the market, what is going to be its beta? Let me represent, okay? So the beta coefficient I want to obtain is for the market. So it will be the covariance, okay, of the market towards the market divided by the variance of the market. That's how it will be. That's how it will be the beta coefficient of the market. Okay, to be the covariance of the market towards the market, we divide by the variance of the market. Okay, so let me get someone. Okay, now this should be equal to what? Okay, let me get someone. Hope at least we have someone who have an idea. If you have an idea how we should progress ahead, don't forget to let me know before I had picked someone. Alex.
I have no idea of the answer.
You have no idea, but you know what is covariance? What is variance? At least you know what is variance.
I was off at some time. My network was bad.
Okay, sorry. Okay, let me ask someone else then. Naomi. Naomi. Naomi, I want to unmute you. Don't feel shy in case you don't have an idea. Don't forget. Oh, it's just say I don't have an idea. Don't forget. Naomi.
Hello?
So now, yes, Naomi.
Yeah.
What do you think is going to be the beta of the market from the formula I've just given? Naomi, you're still there?
Hello.
Yes, Naomi, you seem to be getting lost along the way.
Can you hear me?
Yes, I can hear you now. I lost you again, Naomi. Oh, Naomi seems to have issues. Anyway, let me check on the chat. Now, Asma, let me ask you, okay, how you get it? Okay, so Asma seem to have, and that's my call. So Asma.
Yes.
How did you get one?
Because the covariance,
Yes.
the covariance of M and M is the variance of M.
Yes, that is it. Okay. Thank you, Asma, for that. Okay. Now, don't forget here, okay, to the rest, that the covariance of an asset towards itself, okay? Now, here is M towards M, okay? So this is M towards the M, okay? So it's a covariance of market towards the market. It's simply the variance of that market, okay? It's simply the variance of that market. Covariance of an asset towards itself is the variance of that particular asset, okay? Now thank you, Asma, for that. Okay, so this is going to be therefore be the variance of the market. We divide by the variance of the market. Of course, this will give a level 4, will give us 1. Okay, will give us 1. Therefore, always, okay, the beta coefficient of the market portfolio is always equal to 1. Okay, the beta coefficient of the market portfolio is always going to be equal to 1. Okay. Which means, therefore, if we have an asset, okay, if we have an asset, okay, that is going to have a beta coefficient, okay, if for example, the beta of our I here, okay, the beta of I is, let's say, 1.5. Now, what does that mean? And therefore, this particular stock, okay, has higher systematic risk than the market, okay, because you see the market here is 1, but this one is 1.5, okay. It means therefore simply that this particular stock has higher risk than the entire market, okay, because the market is 1 and this is 1.5, okay, and of course, conversely occur that in case the beta here is 0.8, I mean therefore the market is exposed to higher systematic risk than this particular stock, okay, and of course, as we mentioned, towards the return, okay. So since the market here, okay, if you assume here scenario 1 and here scenario 2. Now in scenario 1, because the risk is higher than the market, it means the return is higher for I, because the risk is high, okay. At the same time, if we consider, okay, security 2, okay, the second scenario, 0.8, it means therefore that the amount of return to be received in scenario 2 is lower than the market. Why? Because the beta, okay, 0.8 is lower than the market of 1. Okay, that's how you interpret the beta coefficient. Okay, that's how you interpret the beta coefficient. Okay, if the stock has 1, if for example the beta of the stock scenario 3, okay, is scenario 3 here. Okay, the third scenario is the beta is equal to 1. Okay, it means therefore this particular stock has the exact same systematic risk like the market portfolio. So in case the market portfolio has a return of, let's say, 8%, and therefore, even with this stock, the return will be equal to 8%, because they have the same systematic risk. Okay, and that's how you interpret what we refer to as the beta coefficient. Okay, that's what you interpret as the beta coefficient. Okay. Question? If you have a question, don't forget the chat could be one of the area, or you can raise your hand up. Now, have we known how you measure the systematic risk? Okay, how have we known how we do measure the systematic risk by the use of the beta coefficient? Okay, the next thing we may want to understand is now how do we now determine the return you'll be receiving as a holder? Okay, based on the amount of based on the beta coefficient of the security you're having. Okay, if I go ahead and also draw here a graph here. So here I have my risk, okay, risk plus return, okay, there's risk and this is return, okay, and here I only want to use the beta coefficient, okay, so here the the x-axis is the systematic risk, okay, is the beta coefficient, okay, the return is the total return that an investor do get. Don't forget the return, this linearity, okay, of return versus the risk, okay. However, if the amount of systematic risk exposure you have is zero, if the amount of systematic risk exposure is equal to 0, in short, the beta coefficient of this particular stock is 0, what should be the return? Let me repeat. Okay, if you have a stock that has 0 beta, it has 0 systematic risk exposure. In short, there's 0 risk that is exposed to. If there's no, don't forget already, okay, this is a diversified portfolio. So first, we don't have any unsystematic risk, which is 0. At the same time, we have 0 unsystematic risk. This asset, therefore, has 0 risk. Now, therefore, what should be there for the return of this particular asset? Okay, if you have an answer, don't forget you can raise on the chat, as I also get to check on someone. Daniel. Hey, Daniel. I have unmuted you, Daniel. Hey, you went mute, Daniel. What happened? Let me check someone else here. Sharon Nyaboke, I want to unmute you. Sharon. Sharon? People are running away from question. What is happening? Let me check on the chat. Okay, so here we have Glois is saying as 0. Okay. I know whether Alois is answering the question. So you're saying 0. If we have an asset that has 0 risk, the return is equal to 0. Alois, I'm not so sure about that. Let me check the others. Stacy is saying that the return you'll be getting is the risk-free rate of return. Of course it is, okay? Alois is saying the answer is. The return you get is risk-free rate of return. So in case we have an asset, okay, that's correct. So in case you have an asset that has 0 risk exposure, it means this is a risk-free asset. Okay, this is a risk-free asset. It has 0 risk exposure. It implies that for the return you'll be receiving as a holder is a risk-free rate of return. Okay, so having that in mind, if you have a 0 risk exposure, it implies the return you'll be receiving, for example, will be the risk-free rate of return. Okay, the risk-free. Okay, I want to represent it as RS. Okay, so it will be the risk-free rate of return. You don't get 0 return, but you get the risk-free rate of return. Now, since you did assume linearity, okay, that the more risk exposure you'll be getting, the more return you'll be getting. Therefore, our graph is going to be some sort, okay? That's how our graph is going to be. The more the risk, okay, as we go towards the more beta coefficient, the higher will be the return that you'll be receiving as a holder. Okay, that's how our graph is going to be like. Okay? In case we graph risk return versus risk. Okay. Now here, if we are to deal with a market portfolio, okay, if you're dealing with the market portfolio, okay, if you're dealing with the market portfolio, therefore the beta of the market portfolio we have just mentioned will be equal to 1. Okay, so will be equal to 1. So therefore, this is therefore a market portfolio. So in case I go up here, my graph here. Okay, so if that's my graph, okay, then I can say therefore my return, okay, therefore I can say therefore the return that I will be receiving, okay, as a holder, okay, assume that this is my graph therefore, okay, this is the risk and this is the return, so this is my return. Therefore, I can say therefore that's the become therefore the return of the market portfolio, because here this is the market portfolio, okay, this is my market portfolio M there. Okay. Therefore, the return, if we going to have a portfolio that has a beta coefficient of 1, we refer that as the market portfolio. So simply, let me just expand this. This is called the market portfolio. And the return you'll be getting for an asset, for a portfolio that is equivalent to market portfolio will be simply the return of the market. Okay, so this is the return of that market portfolio. Okay. Now, having known that, now we can be able now to determine, okay, what is the line equation? Okay, what is the equation for our line here? Okay, don't forget this is simply a straight line. Okay, therefore it's gain b equal to y is equal to a plus bx. Okay, I hope we still remember from your math. Okay, that the line equation is going to follow y plus a, y is equal to a plus bx, because this is a linear equation. Okay, so y is equal to a plus bx. In our context here, okay, don't forget y is the dependent variable. Okay, y is the dependent variable, and this is our y. Okay, therefore it will be return. Okay, let me just call it r. And a, what is a in our equation? A is the y-intercept. Okay, a is the y-intercept. Okay, which you have here. Okay, so let me use it. Which you have here. This is our y-intercept, and what the y-intercept here is the risk-free rate of return. Now, what is x? Okay, x is our the independent variable. Okay, which in this case, therefore, is risk. And here the risk is measured by the beta coefficient. Okay, so the beta coefficient of that particular security I. Okay, the beta coefficient. Okay, now what is b? Okay, what is b? The b is our simply our gradient. Okay, the b is our gradient. Okay, so let me have here. Okay, I want to determine the gradient. Okay, the change in y. Okay, the gradient is simply the change in y. Okay, we divide by the change in the x-axis. Okay, change in y, we divide by change in y in x-axis. Okay, now the change in y, the gradient, the change in y here, the y is starts from Rm all the way. This is the change in y all the way to Rf. We have the change in y is with Rm minus Rf. We divide by the change in y-axis, the change in x-axis. Okay, now this is the change in the x-axis from here to here, which simply is equal to 1. Okay, because here is 0 and here you have 1. So simply we divide by 1. Therefore, we can see therefore the return of security I therefore will be the risk-free plus Rm minus Rf. We multiply by the beta coefficient of that particular security. Okay, and simply this is what we refer to as the capital asset pricing model equation. It refers to as the capital asset pricing model equation. Okay, and this is what you are meant, or this is what we are meant therefore to apply. You don't need to know the process of how you get the equation. Okay, however, you need to know the final equation. Okay, we need to know the final equation. Okay, the return that investor in equity share I, okay, is equal to risk-free plus the return of the market portfolio, and as the risk-free, we multiply by the beta coefficient of that particular stock. Okay, and that's how you do get the capital asset pricing model equation. Okay, you don't have to cram how you get the process. Okay, all you need to know is how to apply the final equation, and how you need to remember. Okay, this final equation you have here. Okay, this capital asset pricing model equation, you need to remember it. Okay, and apply it in a case, in a question. Okay, and having known that, then you can apply the model. Okay, having known that, we can apply our model, our equation, okay, in a question. So let's apply it here. I hope it's clear. If it's not clear, don't forget you can raise your hand, as well as you have the chat. Now, in case I was to apply the question, the model, okay, into a question. So let me go back to our notes. Okay, this is the final equation, which I think I've mentioned already. Okay, this is the capital asset pricing model equation. Okay, the first one is the CAPM. So E here simply represents expected. So E just means the expected. Okay, so the term E should not confuse you. So E we have here, in this case here, okay, and here it simply means what we call expected. And that's why you get the term. We determine the cost of equity by using the capital asset pricing model equation. Okay. If there's no question, then we can apply the model. Okay, so I can go through one, then I can leave you to do two. Go through question one. Okay, hope you've gone through question one. Now here you have a security has a beta coefficient 1.2. Okay, there's 1.2, which means therefore 1.2, which means therefore it has the risk or the systematic risk for this particular security is higher, okay, than the market portfolio, because as you have mentioned, the market portfolio beta is equal to 1. Which means therefore, since this security, okay, has higher risk than the market, okay, and implies therefore the return to be received must be higher than the market. So it must be higher than the 11% here. Okay. The risk-free is equal to 6%. The main determine the required return to the equity shareholder. We say that as per the model, the cost of equity will be the risk-free, okay, equity beta, RM minus RF, okay. Therefore, this will be equal to the risk-free 6%. The equity beta for this is 1.2. The return on the market is 11%. Minus the risk-free, in this case, is equal to 6%. Okay, to give us how much? minus 6 to give us 5%. 5% times 1.2 to give us 6%. 6% plus 6% to give us 12%. Okay, the cost of equity therefore is equal to 12%. Okay. And Extra has confirmed that. Okay, so the cost of equity for this particular question, okay, is equal to 12%. Okay, and that's how you get the cost of equity, by using the capital asset pricing model. Okay, by the use of the capital asset pricing model. Then in question B, okay, so go through question B. Then we attempt it together. Question B, go through it. Next 1 minute. Okay, I suppose you have gone through the question and at least made an attempt. Okay, so maybe just confirm. In case you've already made an attempt, maybe you can post the answer on the chat. Okay. So this question, you're being asked to get what is the beta coefficient? Okay, so in this question, you're being asked to get the beta, and what does this tell us about the return volatility of B? Okay, so if the B has a return of 9%. The return of GLITS. So GLITS is simply a term that is used to refer to government issued security, okay, both the T-bills and the T-bonds, okay. So GLITS is a term that is normally used conventionally, okay, used to refer to government issued security. Therefore, if the term of those government issued security is 5.5%, this therefore represents our risk-free return. With the return of the market is 10.5, so RM, we have it here, okay. And we have the return of the market, the security itself, 9%. So you need to get the beta. Okay, so simply we apply the formula to get the beta coefficient. Okay, so in case I was just go to my board. Okay, therefore with the return of the cost of equity, return of equity shareholder is risk-free beta coefficient. Okay, RM minus RF. Okay. The return for this particular security, okay, we have been told is equal to 9%, okay, equal to 9%. Therefore, 9% is equal to risk-free. The return from the government issued security, okay, you've been told is equal to 10.5%, is equal to 10.5%. So 10.5 percent, we are being asked to get the beta. Okay, so you're being asked to get the beta. Okay, therefore, it will be equal to equity beta for the security. The return of the market portfolio is equal to, no, actually I think I've mixed up a bit here. The risk-free is equal to 5.5%. Yes, I've mixed up here. Okay, the risk-free is equal to 5.5%. So 5.5%. The return of the market portfolio 10.5% minus the risk-free 5.5%. Okay, so we simply work backwards to get the beta. Okay, so we simply work backward to get the beta. Therefore, the equity beta will be equal to 9% minus 5.5%. Okay, we divide by 10.5% minus 5.5%. And we get, I think someone has an answer already in the chat, and you get 0.7% to be the beta. Okay, so 0.7%, 0.7 to be the equity beta for this particular stock. Okay, now what does this mean? Okay, what does this mean? Don't forget, we said that the beta of the market is 1. Okay, the beta for this security is equal to 0.7. Okay, what does this mean? Therefore, this particular security has a lower systematic risk than the market. The risk for this particular equity share is lower, it's 0.7. Okay, for the market is 1. Now, simply we have the return. How volatile are the return of this stock? They are less volatile. Okay, the movement up and down is lower than the market. Why? Because it's beta 0.7 is lower than the market beta of 1. Okay, for the return volatility is lower for this particular equity stock. Okay, that simply is how you're meant to apply the capital asset pricing model. Okay, I hope it's very clear. Okay, so look, if we can take a break. Let's look. Yes, Mosoti.
Yes.
We can take a break.
Yes.
Okay, for how long? 15 minutes or so.
Yeah, 15.
Okay, then we can meet at, let's say, 7:23:24. 7:24.
Yes.
Okay, then we can meet at 7:24. Okay, then see you then. Okay, welcome back for our second session. And we were discussing how we get the cost of equity. And I think now we have discussed both model, the dividend valuation model, okay, as well as we have discussed on the capital asset pricing model. Okay, so those are the two models that we do use when it comes to assessing the cost of equity. Now, which one do we use? Okay, of course, if you're to go to the context of the exam, okay, the information to be given to you will guide you, okay, as to which of the model you should be using. Okay, so simply it's depend on how the examiner or which model the examiner wants you to use. Okay, so the information given should be clear. By default, in case, for example, you've seen the question gave you an equity beta, then most likely the examiner wants you to use the capital asset pricing model. In case you see dividends and you've been given, then most likely you should be using the dividend valuation model. Okay. I think Daniel was asking a clarification on the beta. What does the beta mean? Okay. Don't forget, as mentioned, beta simply is used to assess the amount of systematic risk that we are, the equity investor is exposed to. Okay, to what extent is the equity beta? To what extent is the exposure, okay, of that particular security towards the entire market risk? Okay, but referred to as the beta coefficient. Okay, and we went ahead to discuss if we have a security, okay, that has a beta of 1. Okay, don't forget we say that the market beta is equal to 1, is always equal to 1. Okay, so in case we have a security, okay, that has a beta of 1.5, okay, then it means therefore the risk is a bit high. Okay, it means the risk for this, but it means the systematic risk of this particular stock is a bit high at 1.5. If we have a beta coefficient of 0.8, it means therefore the risk exposure is a bit lower than the market portfolio. Okay. and don't forget the return, the element of linearity. Okay, and you see that if, for example, you have a risk that is going to be, if you have a stock that has a beta of 1.5, and then the return the investor shall be receiving is higher than that of the market, because the market the beta is 1, and since the risk is high, there's more premiums. Okay. Okay, I hope I have clarified that for the sake of Daniel. Okay. The next, once you have been able to get the cost of equity, the next, of course, is to determine how we get the cost of debt. Okay, the next major finance provider. Okay, debt capital. Capital. Okay. Now here for the debt, as you mentioned, don't forget we can have debt in different mode. Okay, you can have bank loans. You can have the bonds financing. The bonds can also you can also have bonds being redeemable or being irredeemable. Okay, so you have to be able to determine what debt are we dealing with. Okay, when it comes to assessing the cost of equity, what bonds are we dealing with? Okay. So if, for example, we are dealing with a case of bonds that are redeemable, okay, if you're going to deal with bonds that are redeemable, okay, let me go back to my board. Okay, if you have bonds that are redeemable, okay, that will mean therefore bonds that are redeemable, okay, and these bonds are redeemable. Okay, let me give you the easier one, okay, bonds that are irredeemable, okay, that's a bit easier to understand. Let me begin with that. Bonds that are irredeemable. Redeemable bonds, okay. Don't forget to go back to our fundamental theory, okay, the fundamental theory of valuation, okay. We have seen that as per the fundamental theory of valuation, the market value of financial instrument, okay, P naught, is equal to the sum of present value of all the cash flow that particular stock shall be yielding, okay. So since this is a bond, okay, the return or the cash flow you'll be receiving is in form of, let me just get someone, okay, to answer it for us. Ebon Tane. Ebon Tane?
Yes.
In case you are a bond investor, what cash flow do you get? Okay.
The principal by the arrow.
Sorry, you get what?
You look for the present value of the cash flow depending on the number of periods we have.
So the question is that what are these cash flows now? What's the cash flow?
These are the bonds which will be redeemed before the redemption days.
So there'll be a redemption value, okay? Of course, the cash flow with the redemption value. What else do you get? There's another cash flow you get, not just the redemption value. There's another cash flow that you do get. Okay, so
the interest.
The interest, of course, the interest, okay? You get the interest, okay? And Esther confirms that. And then we have Luke Amolo has his hands up. Okay, I presuppose, Luke, that's what you wanted to say. If not, don't forget, let me know, okay? So you get the redemption value and also you get the interest, okay? These are the two cash flows you'll be receiving, okay? In this context, we are saying that this bond is irredeemable, okay? Irredeemable. Therefore, there is no redemption to be receiving, okay? So therefore, the only cash flow you'll be getting is the interest, okay? Therefore, you can see therefore the market value, the P naught, okay, will be therefore the sum of present value of interest you'll be getting, okay? Sum present value of interest you'll be getting. And since this bond is irredeemable, okay, therefore the interest you'll be getting is from today, year 0 to infinity. And since the interests do not grow, okay, no, these are not like the equity dividends. These are fixed, okay? Don't forget the interest on bonds is fixed, okay? Therefore, if you recall, okay, the present value, okay, of annuity to infinity, okay, to infinity is annuity we divide by R, Okay, don't forget the interest you are paying or you'll be getting paid by the company is fixed. Therefore, it's an annuity. Okay, and it's to infinity. Okay, that's it. Recalling the formula of present value of an annuity to infinity is annuity. We divide by R. Okay, now applying the same concept here. Okay, we can say P naught, the market value of the bond, will be the annuity, which in this case is the interest. Okay, therefore will be the interest you'll be receiving. We divide by the cost of, we divide by R. Okay, in this case, therefore, the R is the cost of the debt. Okay, so I want to represent R, RD, cost of debt. Okay, therefore, the cost of debt, in case you make it the subject of equation, will be equal to the interest you'll be getting. Okay, we divide by the market value of that equity share. Okay, and of course, we express this as a percent. Okay, and that's how simply you get the cost of debt in case in the cost of bond if this bond is irredeemable. Okay, simply it's interest, we divide by current market value, okay, the X interest market value of the bond in percent. And that's how you get the cost of the bond. If assuming the bond is irredeemable, assuming the bond is irredeemable. Okay. Clear? I hope it's clear. Okay, so this is how we estimate the cost of debt. Interest, cost of bond if the bond is irredeemable. Interest we divide by P naught. Okay. Okay, we can apply that. Okay, in a question, we estimate what should be the cost of the bond. Okay, you can apply this in a question. Okay, let's go back to our notes and we attempt a question on that. Okay, I think I've mentioned this. Okay, the cost of debt refers to the return a firm must pay to its lenders. Okay, so in case the bond is irredeemable, then this will get the cost of the debt. Okay, maybe this in this formula, okay, what seems to be a bit new, okay, is the interest. Okay, so here I'm assuming that the interest you do pay tax. Okay, but in most in conventional cases, if there's no tax payment, then you ignore that element. Okay, because this is the net cash flow. Okay, this is the net cash flow you do get. Okay, so if there's no tax, then you get the gross interest income is equal to the net interest income. But in case you do pay tax, then don't forget you need to subtract the tax you do pay. Okay, just an example. If, for example, the bond pays, let's say, $11 per year, you do pay $11 per year. Okay, assume this is a gross income. Okay, assume this is a gross income, and the tax rate. Okay, and the tax rate is, for example, 30%. It implies, therefore, the net interest income you're getting. Okay, the net interest income therefore will be 30% less. Okay, therefore, the net interest income will be 11 times 1 minus the tax 0.3 to give us a net interest income of 7.7. So in the numerator, we shall be using 7.7. Okay, we'll be using 7.7. Okay, that is assuming, okay, we make an assumption that there's tax. If there's no tax, then the numerator is simply the gross interest income. Okay, if there's tax, then of course we need to reduce the interest income. We need to reduce the interest income by 30%. Okay, and that's how we get the cost of the bond. Assume this bond is irredeemable. Okay. Let's attempt the question. Okay. Yes, you can attempt part A, okay, of that question. We attempt part A of that question. Okay, so go through it, then we attempt it together. Okay, I presuppose that you have gone through it and you have made an attempt. Okay. If we have to assume that this bond is irredeemable, okay, as you mentioned, the holder, okay, there is no return of their capital, okay, so therefore there is no redemption value, okay, therefore the only return you'll be receiving as a holder is the interest, so no redemption value. Therefore, if I go back to our notes, okay, my board, sorry, okay. Therefore, the cost of this bond, I said, is again equal to the interest. Okay, don't forget you need to take into account tax if there is tax. Okay, if there's no tax, don't assume there's tax. We divide by P naught. We express this as a percent. Okay, therefore the interest, okay, after tax, the net interest income will be equal to, this bond is paying at a rate of 10%, okay, it is paying at a rate of 10%, if I remember the figures. It is paying at a rate of 10%, and the nominal value of the bond, don't forget the interest is on the nominal value. It's on the hundreds, not 95. Be very careful, okay? The interest is based on the nominal value of the bond, the par value of the bond, not the market value. So the back to board, so 10% we multiply by $100. In this example, there is tax. In this example, there is tax, and the tax is 30%. Therefore, you don't get the entire 10%. Okay, you need to pay that percent to the government. Therefore, the net interest income, therefore, is going to be 30% less. So 1 minus 0.3 to give us $7. Therefore, the net interest income to be received by the holder is $7 to infinity. Okay, $7 to infinity. So therefore, we have in this case, therefore, we have a numerator. Okay, so we need to get the current market value, and the current market value we told that is equal to, so the current market value we be told is equal to $90. So P naught we be told is equal to $95, is equal to $95. Okay, so having that in mind, therefore, the cost of debt is the interest, and the interest equals 7. We divide by the P naught. Okay, we have it here. We divide by 95, and we express this as a percent. Okay, to give us how much to be the cost of this bond. Okay. Okay, we seem to have people who have got it already. Okay, so seem to be 7.37%, 7.37% to be the cost of this bond. Okay, and that's how you get the cost. That's how you get the cost of bonds, assuming that this bond is irredeemable. Okay, assuming that this bond is irredeemable. Okay, I hope it's all clear, and all of you got 7.37% to be the cost of the bond. Okay, don't forget, what does it mean? It simply means, therefore, that for every dollar, okay, for every dollar the company shall be obtaining, if the company was to issue a similar bond in the market today, okay, was to issue a similar bond in the market today, the amount of return they must be promising the holder, okay, for every dollar they obtain from them will be 7.37 cents. Okay? That's what that particular cost means. Okay? And that's again the cost of bond if they are irredeemable. The next question is, what if they're redeemable? Okay, now what if this bond is redeemable? Okay, how do you get the cost of the same bond if it is redeemable? Okay, now if the bond is redeemable, okay, let me go back to my board. Okay, if the bond is redeemable, okay, so if the bond is redeemable, don't forget now the return you'll be receiving. If I was go back to my previous notes here, okay, now this bond is now redeemable. Okay, I mean, therefore, as a holder, what do you get? You get the redemption value which you have here, and we get the interest, which I think you already included here. Okay, the market value of that bond is the sum present value of redemption value and the sum present value of the interest. Okay, don't forget P naught here, therefore, is going to equal to the sum of present value PV, okay, of the cash flow here being redemption value and the interest. Okay, and therefore the market value of the bond, which I think you have actually already done together. Okay, because we are discussing on market valuation of bonds. Okay, therefore be equal to the sum of the present value of interest. Okay, interest here, if there's tax, you need to tax it. Okay, from the first year, okay, we get the present value from the first year, I is equal to 1 all the way until the time of redemption. Okay, plus the redemption value, the present value of the redemption value. Okay, present value of the redemption value. Now we want to get the cost of debt. Okay, this is what we want to get. Okay, this is what we want to get. Okay, for this particular bond. Okay, we have all the variables. We have the market value, we have the interest, we have redemption value. So we need to get the RD. Okay, in this example, you cannot make RD or the cost of debt the subject of the equation. Okay, that won't be possible. Okay, so what do? You're going to be using a trial and error method. Okay, so you're going to be using a trial and error method. Okay, And if you remember, what we thought was the IRR method, which I think we have discussed in detail before. The IRR method, okay? That's what we're going to be using when it comes to estimating what should be the market value of the bond, okay? Okay, don't get here, P naught will be equal to the interest you'll be getting. Don't forget this interest is an annuity, okay, times therefore the present value and factor, okay, n years R%, okay, don't forget the R is your trial, okay, plus therefore the present value interest factor, okay, n years R% multiplied by the redemption value, okay. I think you've done this already together, okay. In case, for example, we do discount these cash flows at the correct R, okay, at the correct cost of debt, then of course the sum of the interest, the sum of present value ought to be equal to P naught, okay. I think we've done this that one already, okay. That the sum of the present value, okay. So the two should be equal to, okay, this is an equal sign, okay. So in case we were to discount the interest and discount a redemption value at the correct cost of this debt, then the sum present value of the interest should be equal to, and the redemption value should be equal to the current market value of the bond, okay. In short, the difference should be zero, okay. Therefore, 0 should be equal to negative P naught. Okay, what I've just done is I've taken P naught to the right hand side of the equation. Okay, so plus, okay, the present value and its factor, okay, times the interest, okay, plus the redemption value in present value terms, okay, n years R%, okay. So the difference should be equal to 0, okay. That is in case we were to discount the cash flows, the interest and redemption value at the correct R. What if in our first trial, okay, we don't get 0, okay? We go to a second trial, okay? And all we need is 2 trials, okay? Don't forget, I think as per the IRR, we have done this already together. Okay, we just need 2 attempts, okay? We use a trial, determine if you use 3%, what do you get? If you use 4%, what do you get? Okay, then compare the 2 of them. Then use the extrapolation method, the IRR method that we discussed then to get what should be the cost of the debt, okay? And that's how you get the cost of the bond if it was to be redeemable, okay? If it was to be a bond that is redeemable, okay? The use of trial and error method. Now, in case I was choose we want to get now the cost of the same bond, okay? The cost of the same bond if this bond, okay, is redeemable, okay? What I mean by that is if you have to go back to a question here, okay, we want to get the cost of the same bond if it's going to be redeemable in year 10 or redeemable in 5 years time, okay? So the cost of this bond, the redemption is occurring in year 5. Now in this question, okay, don't forget there's no mention on the redemption value. There's no mention of at what price, how much will be the investor getting in year 5 upon the bond redemption. It is silent. Don't forget what we mentioned. If that's the case, we assume the redemption is occurring at the nominal value, is occurring at the par value, in this case, the $100. Okay, so let's go back to our board. We do the question now. Now for the P naught, we have said the market value of this bond is 95. So 95, therefore, is equal to the interest that we do get, okay? Then we go back to our working head here, is equal to the interest which we got here, okay? So you already have the interest, is equal to the interest, okay? We discount back to year 0 plus the redemption, the present value of the redemption value, okay? Therefore, it will be equal to, go back to my board, it will be equal to the interest, which we got 7 times the present value annuity factor. Now, the redemption in this example, in our first example, is occurring in year 5. So the redemption is occurring in year 5. Okay, so the first case is 5 years. So the interest we'll be getting will be from year 0 to year 5. From year 0 to year 5. Okay. Let me go back to my board. Therefore, it is 5 years, R%. Okay. That gives therefore the present value of the interest plus the present value of redemption value. So redemption value, okay, we already have it. Since the question is silent, okay, we can already mention that. Since the question is silent, we assume the redemption occur at the par value. And the par value of this bond is 100, present value interest factor, 5 years, R%. As I mentioned, trial and error method, okay? So in case we discount correctly, then we ought to get a 0. So 0 is equal to negative 95 times 7 times present value and its factor, 5 years R% plus 100 times present value interest factor, 5 years R%. So it's a trial, okay? If, for example, we try 7%, okay? If our first attempt, okay, our first attempt here is, let's say, 7%, okay? 7% is our first trial, okay? Now, what will be therefore the sum of this? If you 7%, it will be equal to, okay, 7%, the first attempt will be negative 95. This should not be a plus, should be a minus, should be a plus, sorry for that. This should be a plus, not a multiplication. Plus 7 times present value and its factor, 5 years, 7%, multiplied by 100 times present value interest factor, 5 years, 7%. Okay, I've just taken 7%. You can take another value. Okay, but for the sake of us being consistent, let's try 7%. Okay, but it's just a trial. Okay? Now, what do you get therefore to be the sum of those figures? Okay, if we were to discount the cash flows at 7%. Okay, you tell me once you get an answer. Okay, Stacy, you get 5, and Naomi, I think you get 5. Okay, I want to assume that all of you have 5. Is it positive or negative? Is it positive or is it negative? Naomi? So Alex, what do you get? Alex? Yes, Alex.
I'm getting 5.
Positive, negative?
Positive.
Okay, thank you. So you get positive 5. Okay, thank you, Alex. So you get positive 5, therefore, to be the sum of those cash flows. Don't forget our aim was to get the 0. Okay, don't forget our aim was to get a 0 here. Okay, but you haven't got it. Okay, but now you can have a second trial. Okay, so what if I follow the steps and process? Okay, but now I discount the same cash flows at, let's say, for example, 8%. Okay, at 8%. Just an example. Okay, the same process, but now we discount the cash flows at 8%. Okay, okay, at 8%. So now here is our second trial. Okay, at 8%, it will be equal to negative 95. Okay, plus 7 times present value and its factor, 5 years, 8%. Okay, plus 100 times present value interest factor, 5 years, 8%. So what do you get in case you use 8%? Okay, seems someone have an answer already.Ebontane. Okay, you get 1. I hope it's positive 1. Confirm with it's positive, negative. So now we get 1. So it's positive 1. Okay, positive. Okay, so you get positive 1. Therefore, to be the sum of those cash flows, to positive 1. Then we can simply use the extrapolation method. So you don't need to try as many. 2 trials are okay. Okay. So now we can extrapolate the results. Okay, we can extrapolate the results now. Okay, so in case I open a new board here. Okay, at 10%. Okay, at 10%, we got positive 5. At 8%, we got what? We got 1. Okay, now we can extrapolate the results. Okay, we can see therefore is that using the IRR formula. Don't forget you're using the IRR formula, which I hope that you still remember. Okay, the IRR formula. Okay, you're going to see that the cost of the debt RD will be equal to, at 7% we got 5. So our lower discount rate here, 7% is equal to 7%. Let me just remind you the IRR formula. Okay, for those who may have forgotten. Okay, the IRR formula is given as A plus B minus A, present value at A, present value at A minus present value at B, okay, or the NPV, whatever you want to call it, okay, where A is the lower discount rate, B is the higher discount rate, okay. Yeah, present value at A is the present value of the NPV at the lower discount rate, PVBB, present value at B is the present value at the higher discount rate, okay. I presuppose that you remember all these things. Okay. Therefore, we can see the cost of debt. Okay, applying the formula, A is 10%, then 8 minus 7, okay, percent. The value at 10%, we got positive 5. So 5 divided by 5 minus 1. And that therefore will give us therefore the cost of our debt here. Okay, and what do you get? I've simply applied the IR formula from our attempt here. Okay, and I get 7 points. Okay, 8 points, should be 8 point something. Okay, 8 points. I'm waiting for an answer. Someone have an answer already here. So Asma and Esther, we get an you get 8.25. Okay, so suppose all of you have that 8.25%. Okay, the 8.25% therefore the cost of this bond if it was to be redeemed at the end of year 5. Okay. So all you need is 2 trials. You don't need to have 3 or 4 or 5 trials. Okay, just have 2 trials. But don't forget to ensure that the 2 discount rate you're using, the 7 and the 8, for example, in our case here, are as close as possible. Okay, so you can't choose, for example, 10% and 20%. Okay, you're going to have a higher error of estimation. So ensure that the rate you're going to be using are as close as possible. And if I don't know whether you have noted, okay, here I did use 7%. Okay. Generally, okay, the cost of the bond, okay, like this bond being redeemable is not too far off, okay, from the cost of the same bond if it was to be irredeemable. So if you remember in a previous example, okay, where the bond, we assumed the bond was redeemable, we got, what did you get? How was it? In the same question, we got 7.37%, okay. So the cost of this bond, if it was to be redeemable, okay, we have it here, won't be too far off. Okay, so that's why I did choose my 7% as my first attempt. Okay, so the cost of the same bond, if the bond was to be irredeemable, okay, and its cost, the cost of this bond that is irredeemable won't be too far off from the cost of the same bond if it was to be irredeemable. Okay, and don't forget, to get the cost of the bond that is irredeemable is quite straightforward. Interest divided market value. Okay, that can give you a hint. Okay, where your answer should be. Okay, and that's why you can see here, I did start from 10%. Okay, that is, it's simply meant to make your work a bit easier. So reduce your number of trials. Okay. So guys, I can propose that you attempt the same question, okay, but now the redemption is occurring in the 10th year. Okay, the same question, but redemption occurring on the 10th year. Try it out. You see what answer you do get. Okay, so the part B of the same question, if I was to go back, is now what is the redemption is in year 10? What would be the market value of this bond? What would be the cost of the same bond? Okay, so on your own free time, I would propose that you try that out. So next is a question. I would want to end the class there. Okay, let's check on the chat whether there's a question that I have not answered. So Amolo was asking whether I can comment on volatility. Okay, volatility. Okay, just to make comment on the question Amolo has asked. Okay, so let me just share. So volatility is simply how the returns move up and down. This is called return volatility. How do they move up and down? Okay, so in case the return, if we have, let me say this is graph A. I just want to make a quick comment on the question raised by Amolo. If we have, for example, those 2 graphs, okay, we have A, we have B. Don't forget, B is less volatile. The returns don't fluctuate too often, okay, for B. For A, you can see they're moving up and down quite frequently, okay. So we can say the risk in A is high, okay. So we have here a higher risk, okay. So the risk here is a bit higher, okay. Here the risk is a bit lower, okay. So you can see that maybe that A has a higher risk, okay, has maybe, for example, higher systematic risk compared to B, okay. And of course, they have the volatility, and the more the risk they have, okay. And in that case, if I remember what we are doing, we had the market had a beta coefficient equal to 1. For that stock, its beta was equal to 0.7. That's what we said. Market is more volatile compared to that particular stock. Okay. I hope I've answered I've answered your question, Ramolo. Okay. So any question you can have there on the chat. Don't forget, you need to sign the register. Okay, so your admission number and your name. If no question, then we can end the class there. Okay. So enjoy your evening and see you next week. Okay. And next week, don't forget, we may do some multiple choice question. Okay. Right now we can't be able to do the assignment, so I think we shall be doing some multiple choice question to help us in grasping the material that we have gone through. Okay. Assignment might be hard for now, but we devise some new ways. So we may attempt, okay, some multiple choice question. Okay. See you next week, therefore. Enjoy your evening, and bye.